We had some massive news for stock market investors on Friday as the Bureau of Labor Statistics reported the quarterly, or I should say monthly, job increases for July, but they also provided revisions for May and June, and those revisions sent the stock market lower. Why did that happen? I'll answer that in this video. What were the revisions? I'll share those with you in this video, and I'll talk about and discuss why and what it means for stock market investors overall. And then I'll try to highlight specific stocks where this unemployment report could be a more important factor, and some stocks where it might not be as important of a factor. So let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so total non-farm employment changed little in July and was up 73,000 for the month. The unemployment rate at 4.2% was up from 4.1% in the previous quarter, and the unemployment rate now has steadily increased over the previous 2 years. Speaking of which, on July of 2023, the unemployment rate in the United States stood at 3.5%, and it's been steadily increasing as of the most recent update for July of 2025 at 4.2%. Fears of a recession were increased since 2023 because of this factor, because of the increasing unemployment rate. But those fears have kind of decreased as the United States economy continues to perform despite these headwinds that investors were concerned about and economists were concerned about. You can see the rate of increase from July of 2023 till about July of 2024 was much sharper. And since July of 2024 to July of 2025, unemployment has been relatively flat, right? It's been down, it's been up, but it's been the same. If you look back year over year, it's at the same rate it was since July of 2024. The sharp increase came from July 2023 to July 2024, and then between 24 and 25, it's been relatively steady. The big change is the Federal Reserve, the central bank, increased interest rates sharply starting in late 2022 and throughout 2023. And when the central bank is increasing interest rates, it's decreasing economic growth. You could think of them being as inversely related. And the reason for that is many of the big ticket items people buy are correlated to interest rates. So if you're thinking about buying a car, if the interest rate is higher, your monthly payment will be higher, and so you'll be less interested in buying a car. The same goes for buying a home. If the interest rate is higher, your mortgage payment will be higher, and you'll be less interested in buying a home, or you'll be interested in buying a lower priced home. So higher interest rates are like gravity to the economy. They slow it down. And that's why you saw unemployment increasing between July of 2023 to July of 2024. So you might be thinking, well, if it slows down the economy, why does the central bank increase interest rates? Why don't they just lower interest rates so that the economy can perform better? That's a good question. And the reason is because the central bank has two jobs, two very important jobs. Number one is to keep unemployment stable and low. Number two is to control inflation and to keep inflation at around 2%. And those are offsetting goals. The central bank can keep unemployment low if it's okay with letting inflation get out of control. If it keeps interest rates very low and continues to stimulate the economy, that will keep unemployment low, but then inflation will get out of control, right? And you wouldn't be happy about that either. You might have a job, you might be making $1,000 a week, but then when you go out to spend your money, you realize that it doesn't get you very much. And the cost of living continues to increase. And the cost of living, if inflation gets out of control, will increase faster than your wages will increase. So you'll continue falling behind and behind and behind as the cost of living increases faster than your wages increase. So that's why they have to consider both sides of the equation. And I know President Donald Trump has been aggressively targeting the central bank leader, Jerome Powell, asking him to lower interest rates. But the reason why the central bank chairman hasn't lowered interest rates is because unemployment is at historically low levels still at around 4%, and inflation is above the 2% target. So right now, the central bank sees inflation as the bigger risk compared to unemployment. So the labor force participation rate at 62.2% declined by half a percentage point over the year. That means fewer people are interested and are looking for work. And that's a bad sign. That means that people are not seeing attractive jobs. And so they're not going out and looking for jobs because they look around and they say, man, I don't want to work at McDonald's, or I don't want to drive for Uber. I don't want to work at Domino's. And these are the most common jobs that are available right now. High quality corporate jobs with high salaries and tech jobs are less available than those other types of jobs. And I follow hundreds of companies, and corporations like Microsoft and others have been cutting jobs and laying people off, while companies like Domino's and Starbucks and McDonald's have been desperately searching for workers. So those are the kinds of companies that have a lot of jobs available, whereas corporations in roles like financial analyst or human resources manager, those type of jobs have been less available, and those are the types of jobs that are getting cut. So the number of people not in the labor force who currently want a job was up by 568,000 year over year. So more and more people would like to have a job, but they're losing confidence in the labor market, so they're not even trying. And that's a bad sign. Furthermore, I've been talking over the past few months how the jobs that are being created are not correlated to business strength. In July, healthcare added 55,000 jobs. So total jobs were 73,000, 55,000 of which was in healthcare, right? Healthcare jobs have been increasing at a faster rate in the previous year, and that's not a good sign, right? That means people are getting more sick and demand for healthcare is increasing, and healthcare is not correlated with business strength. People seek out healthcare regardless if they have a job or don't have a job, or if they're feeling confident or not feeling confident. So it's not correlated to economic strength. Social assistance employment trended upward, added 18,000 jobs in the month. That's not good either, right? If people are doing worse, that's when they seek out social assistance. And so with increasing social assistance jobs means more people are needing assistance. That's not a good sign either. And of course, the federal government has been shedding jobs all year long. They let go of an additional 12,000 people in the month. And actually, I think there's more job losses in this category because a lot of thousands and thousands of employees are on paid leave from the federal government, and they're receiving ongoing severance pay. They're included as being employed because they're still getting a paycheck from the federal government, even though they've been told to leave. So employment is down 84,000 since reaching a peak in January. And of course, this has been the goal of President Donald Trump. And then when he was friendly with Elon Musk before they had their bromance was broken up, they were aggressively looking for job cuts in the federal government. And again, this is not correlated to macroeconomic growth, but when the federal government is shedding jobs and when they're spending less money, longer term, that's a positive sign for the economy, because if the federal government is spending less, then the federal government will be taxing less, or won't feel the need to tax people as much. And if they're not taxing people as much, that means you have more money in your wallet to go out and spend. Over the previous 12 months, average hourly earnings increased by 3.9%. And importantly, that's faster than the rate of inflation over that same time. So people's real disposable income increased, meaning they were ahead, right? Over the last year, their wages increased more than inflation, so their purchasing power increased. And that's the most important thing, is purchasing power. That's why you care about your finances, is because you want to buy more things and services with your money. You don't just want money just for the sake of having money. You want money because of what you think you can convert those dollars into. Things like furniture and haircuts and homes and cars and jewelry, etc. That's what you're interested in. And if your wages are not increasing faster than the price of things are increasing, you're falling behind. But over the previous 12 months, average hourly earnings actually increased faster than the rate of inflation. That means people were better off this year than they were last year. Surprisingly, in manufacturing, the average work week held steady and overtime actually decreased to 2.8 hours. And the reason I say surprisingly, because President Donald Trump has instituted a huge increase in tariffs on the United States trading partners with the goal of increasing U.S. manufacturing employment, but that's not happening. And that's not happening because worldwide our supply chains are so intertwined that when you increase a tariff on one country, even US manufacturers who manufacture everything in the United States, they are still impacted because the components they're using in their manufacturing process are likely coming somewhere from overseas. At part of their supply chain is based overseas. And so when you're increasing tariffs, you're increasing the cost of those inputs, which makes businesses spend less on those inputs and manufacture less because they know they will have to raise prices on their customers, and they know that that will cause their customers to spend less money. So here's the big thing that caused the stock market to fall. Major indices were down between 1 and 2.5% on Friday, and this was the reason. The revisions for May and June. So the change in total non-farm employment for May was revised downward by 125,000. So previously they reported an increase of 144,000. That was revised lower to 19,000. The change for June was revised down by 133,000, an even bigger revision to 14,000. So both, if you include May and June, 258,000 fewer jobs were added in May and June than previously thought. And so that caused the stock market to decline, because part of the reason the stock market had been booming is because the job gains from May and June were surprisingly robust. And investors thought, oh, the tariffs are not having that big of a negative impact. But when you look back now and you see these very low job increases in May and June, those fears are now rekindled. Those fears of, oh my goodness, these tariffs are going to make business activity decrease meaningfully. It's going to make consumers pull back and spend less money. It's going to make businesses hire fewer people, perhaps let go of some people, not create new jobs when there's a vacancy, to not fill that vacancy. And these revisions rekindled those fears. And so that's why the stock market fell on Friday. And I wouldn't be surprised if this downtrend continues into next week, unless there is some big development over the weekend, which there has been many times over these previous few weeks, as President Donald Trump is a very active president, making announcements, making tweets, making a deal, canceling a deal, pausing a deal, extending a deal. And all of that activity is actually making things worse for businesses, because they can't make any decisions with all of these changes. They can't even, even if they wanted to, let's say, bring back their manufacturing to the United States, they're afraid to do that because they don't want to make that decision and make that huge investment to bring manufacturing back to the United States. And then next week, President Donald Trump announces a big deal with China, reducing the tariffs again down to whatever, 10%. And then the business owner is like, oh man, I just spent all this money bringing my manufacturing back to the United States. And now you announce a deal with China, and I'm now at a disadvantage because my manufacturing business in the US is going to be at a disadvantage because it's going to cost lower in China. And so that's why businesses are just saying, all right, I'm just not going to make any decisions. I'm not going to hire anyone. I'm not going to bring back manufacturing. I'm just not going to do anything. I'm just going to wait to see how all of this shakes out until I can make a decision, because I just don't have information to make any decisions. So specifically speaking, every business that's selling things is going to be at a disadvantage over the near term. Every business that's selling services is going to be at an advantage now. So think of companies like Netflix. They will be at an advantage because they're selling you a product where you can get a whole month's worth of entertainment for less than $20 a month. And when you compare that with spending money on the type of things you were formerly accustomed to spending money on, and you see the prices of those things increasing, you're going to say, whoa, I used to buy this thing for $15 and now it's $25. I don't want to buy that anymore. And I'd rather, Netflix now is a better value, or getting a haircut now is a better value, or going to a theme park now is a better value. So as an investor, be cautious of that. Look out for these things. Businesses and service businesses and good selling businesses will be impacted differently. Businesses that are selling goods more so than businesses that are selling services. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.